Hi, everyone, and welcome to the webinar keynote from the Center for Real Estate and Finance. We're going to be talking about transactions today. My name is Steve Carvel. I'm the director of the Center for Real Estate and Finance at Cornell University. And of course, welcome to all of our people who are watching right now. And I'll start out by welcoming our participants. We have Daniel Peek, who is at Hodes W Elliott, Eva Wasserman at GTE Realty Capital, Shai Zerling, who is at Brookfield Real Estate, and Art Adler, who is also the chairperson of the board at the Center for Real Estate and Finance. So we anticipate an excellent panel discussion today. I do want to ask all of the people out there who have questions along the way to please post them as they come up, and as I can, I'll try to ask them during the sessions, and then we'll have some time at the end to ask questions that we haven't covered yet. So without further ado, I'll turn it over to Art Adler, who's going to be the moderator today. Art?
Hey, Steve, thanks so much. Appreciate everybody joining, and I appreciate our panelists spending the time. I would certainly be remiss on any panel where we're talking about hotel transactions, not recognizing the incredible contribution that Mark Elliott made to this entire industry. For those of you who don't know, Mark passed away very, very recently, unexpectedly. He's been a mentor to really all of us in the industry. And Dan Peek, who's president of the hotel division at Hodes W Elliott has had the pleasure of working with Mark directly over the last few years. So, our condolences, heartfelt condolences, go out, Dan, to you and the entire HWE family and Mark's family. So I just wanted to mention that right at the start of this. But let's get into it, as Mark Elliott would have wanted to have done, is just get right into it. So why don't we start out so that you have a little bit of context on who these panelists are and what their level of expertise and involvement is in the industry, by having each of you talk about your business. Tell us, what you do, how much you have to invest, what you've invested in recently, a little bit about your portfolio. So Eva, why don't we start with you? Talk about GEM.
Thanks, Art, and good afternoon to everybody. I work with GTE Realty Capital. I've been there for almost 10 years. We are a private equity real estate investment firm. We're based out of Chicago, and we've been in business just a little bit less than 30 years. Today, we are out actually raising our Fund 7, which is exciting. We're expecting that to be around $1 billion of equity. And that will be invested across all asset classes of real estate. In addition to our private side of the business, we do have the securities side of the business, but I'm not actively involved in that on a day-to-day basis, just work closely with that team that looks at hospitality investments. And so looking at our funds that we've invested today, we are an opportunistic value add investor. We have one fund that is more of a core plus, but we are not actively investing that fund in hospitality today. So my focus is completely on opportunistic opportunities. Our portfolio consists of, on the hotel side, 11 hotels, and they're really across all asset classes. We own everything from Holiday Inn and Disney to, a high-end luxury resort out in the Napa Valley area. So we're always just looking for where we can find the best risk-adjusted returns for our investors. So that's kind of a quick overview on GEM.
Great, thanks. Shai, your little company.
Good afternoon, everybody. Brookfield is an alternative asset management company with about $600 billion of assets under management, spanning over 30 countries. Our investments include 4 groups: real estate, private equity, infrastructure, and renewables. Within real estate, we have about $14 billion of hotel assets under management, and those span Leela Hotels in India, Atlantis in the Bahamas, Center Parcs in the UK, as well as single assets. Similar to Eva, we invest through opportunistic funds. Our latest fund is about 17 billion, and we're in the midst of raising our next fund. Again, for all real estate with an allocation for hotels. So looking forward to the discussion today.
Great. Dan, why don't you talk a little bit about your business at Hodes W Elliott?
Sure. Thank you, Art. So I'm a lifer in the hotel transaction business, a hotel school grad myself. I serve, privileged to serve as a president of Hodes W Elliott's hospitality division. We're a 40-year-old firm based in Atlanta. We operate from 7 offices here in the U.S. and in London. Our business for most of those 40 years was in the hospitality transaction business. Over the last half a dozen years, we've grown into, we've added a commercial division that handles transactions involving office, multi-housing, et cetera. And then very successful capital markets business, which places debt and other, kind of debt-like vehicles for hospitality and other assets kind of across the class, but heavily in the hospitality space, as is our sale business.
Yeah. Terrific. Appreciate that. So yes, so it's interesting. I mean, obviously Shai and Eva, see what they see within their companies, which is a lot. And then Dan has a very, very broad perspective on both the debt and equity sides. All right, so what I'm going to do is I'm going to put a couple of slides up just to provide some context of where we are in the transactions market. So Chris, if you could just put slide 1 up. And what this shows is total quarterly volume, transaction volume over the last 20 years. As you can see, it's extremely cyclical. Sort of as goes the economy, so goes not only demand, but also goes transaction activity. Peaked in 2007, then cratered at the Great Recession. And then it peaked in 2015, and we had a very long, sustained, fairly steady volume of transactions even after it peaked in 2015. And then obviously it crashed with the pandemic. But it was already starting to fall off a bit before the pandemic, as we were sort of getting towards late in the cycle. But, distressed sales really, as you can sort of see in 2020, most of those deals occurred in the first quarter, really didn't see a lot of distressed sales. That's why volume was so low. Probably really replaced by rescue capital, preferred equity, and debt restructurings, which this panel will talk about. But you can see it's pretty anemic at this point. On slide 2, if you could turn to that slide, the left side of that slide shows single assets versus portfolios going back the last 13 years. And you can also see here where we had big years in 2007 and 2015. There was a lot of portfolio activity, which we really haven't seen a lot of recently, but we'll be talking about that. When you had single assets, volume was still robust, but a little bit lower. And the right side of the slide shows who was buying. And the consistency there is private equity has been the dominant buyer. And then in different years, there were different types of buyers, whether it was REITs or high net worth individuals or owner operators who were buying. But again, the stalwarts were the private equity markets. And we will find out from this panel who will be buying, where they'll be buying, what they'll be buying, and when. So again, this just gives a little bit of perspective on the peaks of 40 and 45 billion and the nadir that we're at now, which is about $1.5 billion in the first quarter of the year. Okay, you take those down and let's get into it. So let's start out by talking about sort of playing defense before we start talking about the future. And we haven't had one of these panels in almost a year, specifically relating to transactions. And maybe even, and Shai, you can share how you sort of made it through the pandemic with your hotel properties. Did you close hotels? When did they reopen? What lending programs did you avail yourself of? Did you secure debt restructuring capital, rescue capital? Just sort of walk us through briefly how you made it through. Eva?
Sure. I'd say all of the above would be the answer. So of our hotels, we closed 8 of the 11 back, in March 2020. And slowly those reopened. The last one to reopen was by October of 2020. The one caveat, and it's been interesting, I think we've all learned too much through this. One of our hotels in Southern California that had a lot of restrictions we actually opened the hotel only on weekends, and on weekdays we didn't reopen it because, similar to most hotel owners, we saw leisure coming back, being strong over weekends, not as much during midweek. And so, things that none of us thought was ever possible, what hotel was only open on weekends, but we tried everything we could. With our lenders, I think overall we found that our lenders were willing to work with us on deferrals early on. Ultimately, we had a few where we had recapitalized. We did some pay downs on to get term. For us at GEM, getting additional term was very important. That's what we talked with all of our lenders. We didn't want to be in a position where we were ever forced to refinance or sell an asset. So we really focused on getting extensions, even if we had some type of a minor pay down as part of that. And then having different covenants within the loan waived, restructured, deferred, things like that, because as our cash flow is coming back now, we still went past traditional debt coverage tests and things like that. So we've been working with our lenders even as recently as this past month to continue to adjust what those look like as we come out and our properties get back to a more stabilized operating level.
Thanks, Eva. Shai, if you could respond to that as well. Your portfolio is obviously very large and diverse. How much term do you need on these extensions and forbearance before because you don't want, if you can't have a constant gun to your head. You can't operate that way. So talk a little bit about what you did. And you had made some fairly large acquisitions shortly before all this occurred.
Yeah, I think if we focus in the U.S., I think lenders had a lot of good takeaways from the two previous crises. So let's separate both balance sheet lenders and CMBS, right? It's two very different businesses. I found the CMBS environment to be a little bit less collaborative, right? It's a different business and they weren't as flexible. The balance sheet lenders really understood the scenario really well and were quite collaborative, as Eva mentioned. I think we got good extensions on maturity. The key for us, and I think for everybody in the business, was cash management, right? Very early on, starting February, when you got the view of what's happening, you had to get very quickly an expert in cash management. And what we discovered truly is that there was a lot of cash sitting, be it on the management companies or our accounts, that wasn't being optimized. But the big wins were in the flexibility of using either debt service accounts or FF&E accounts to use a lot of the operating shortfalls and the interest, the debt service. So I got to tell you, it was a very collaborative effort. I think that the lenders understood there's a lot of volatility and the lack of visibility, at least in our case. I feel they thought that the asset is in best hands with an owner-operator, right? You really don't want to step into the situation we were. So we got good runway. I think, we have about 18 months or 2 years through the recovery. But I think the fact that we kept up with all debt service payments spoke very highly to the Brookfield reputation. So I think that was a big part of that. In terms of a closure, to the extent that the local ordinances allowed us to remain open, we stayed open, except in cases where the hotels were heavily reliant on group, and group ceased to exist. So even if you were able to remain open, the nature of the way those hotels operate forced us to close them for a period.
Got it. So Shai, you had indicated that you continued to pay debt service throughout 2020. So you did not request or receive forbearance, in other words, adding the debt service, sort of to the back end, to the principal balance, and because obviously you needed to pay operating expenses and insurance.
Well, it's kind of the curse and a blessing of being Brookfield, right?
Right.
On one hand, you have access to capital, and you can weather the storm. But the main thing for us was that nobody needs a reminder. We were at the end of the cycle when the pandemic started.
Yes.
So what you do towards the end of the cycle, you start really preparing for it. So we made sure that we have dry powder. We also made sure that we had enough money for a down cycle. So we went through a refinancing from 2018 through 2020 that allowed us these terms. So, weathering the pandemic was a lot thanks to our capital markets team preparing and refinancing and making sure that we're in a good footing. Reputationally, I think Brookfield is coming out of the crisis much stronger, given the fact that we didn't have to go into forbearance and we were able to keep up. Now, there are certain instances, certain markets that will require us further conversations, but that's on a case-by-case basis.
Understood. Yeah, I mean, you're right that lenders were flexible. Part of the reason is they didn't want the assets back. They're much better hands and much better stewardship under your hands. Dan, why don't you provide sort of the broad perspective that you can in terms of what your experience was with how lenders dealt with this and what you did to help your clients to bridge to a recovery.
Sure, and I think also part of what's in the background here, particularly on the balance sheet lender side, is lenders got a lot of regulatory relief that was sort of buried within the COVID relief bills, both the one passed over the summer and the one passed in December, which really extended that regulatory relief through the end of this year. So I think there was a bit of support relative to that, but also the balance sheets of the lenders were in much better shape than when we hit the Great Recession, and they were nearly as challenged. But I think number one, the lenders were fearful of taking the assets because their basis was going to go up every day if they did. So as a result, they set back a little bit. But two, I think, generally patience, people have learned over the last few cycles, and I think Shai referenced this, generally patience has been rewarded for lenders. So a lot of forbearance, certainly a lot of, restructurings, particularly on the covenant side, as Eva mentioned, and then, helping our clients, I think, we probably did about $1 billion of what I'll call runway or rescue capital transactions. Shai Art, we worked on one of those transactions together during the process of it. And so you saw people raise capital to put themselves in a better position on the balance sheet, one, to fund their carry, and two, to be able to address where they can create term, right? So in other words, if you could do a pay down of 5 to 10%, establish some form of 12, 18% interest reserve, you could gain significant term advantage and get through the other side. So I think there was a lot of that we helped our clients with. And then in the sort of the second half, since then, as the capital markets have reopened, I think we've seen a significant uptick in refinancing activity, which has allowed folks to, again, kind of manufacture longer term by refinancing a loan that might be coming due, kind of over the next 12 months. And so I'd say that's what kept us busy. Beyond just transactions, as we get into the transaction market, a lot of what happened in the transaction market also played into that, where people chose to sell certain assets to raise capital to defend others.
Yep. No, that makes a lot of sense. And we'll also talk about, obviously, the financing markets going forward. So just stay on the existing portfolio for just another moment. Shai, you referenced using FF&E reserves sort of as a pool of capital that's available. Obviously, now we're going to have several years of deferred maintenance and may go on even a little longer than that. Maybe even you can talk a little bit about how you get the hotels renovated and repositioned to exploit the inevitable upturn. So that's one area I want you to talk about. But I'd also like you to touch on which of your properties are performing best. In other words, as now there's been a lot of articles about airports are full, airplanes are full, hotels are opening, the leisure markets are fantastic. Maybe you can talk a little bit about the recovery and what you're seeing and where you're seeing it take hold. That's sort of a two-part question, mostly for Eva and Shai.
Do you want to start, Shai?
Sure. Yeah. From a CapEx, I think that you hit the nail on the head. There's going to be a slew of assets that maybe are not very differentiated that will not get a renovation in the marketplace, and the customer will start feeling, right? And if you look at the impact of previous crises in other countries, you see that there is a little bit of a deterioration of the quality of assets. We haven't seen it in the US because here I think we deal with a lot of new builds and the brands keep everybody on point. For us, we saw this as an opportunity to expedite renovations, right? Because the issue for us many times is, well, we want to renovate, but what is the cost of the cost of displacement, right? You're typically when you're renovating a lobby or common areas, there's a lot of displacement revenues that goes a long way. And as you know, projects never start on time, they never finish on time, so it really becomes a hurdle. In this occasion, there was no demand. So it was ideal time to really push forward on the investment and renovate hotels that were due for renovation. So I think to the extent that you're a long-term holder of assets, and to the extent that you were preparing for these renovations, it was a great opportunity. There are a few marginal assets in marginal markets that are just going to get the deferral aspect that you're alluding to, and we'll see quite a bit of those, specifically when you look at the loans that are now in special servicing. Mm-hmm. Right? Those, forget about it, and it will present a huge opportunity. Right? It will present a huge opportunity as we work through that funnel in 2 years to buy hotels and really provide capital, again, to the extent that these are valuable assets in the long term.
Well, yeah, I mean, like any period of time, this is no different, where you have to do your hold sell analysis as to whether it makes sense to reinvest in a specific property versus, maybe there's a higher and better use for that capital if you can, pay down the debt and sell it. Eva?
The same thing where we had planned on renovations because, we are a long-term holder of our assets and we're underway. And so we have less displacement, which is great. I'd say, the struggle we're seeing across the board, like we've all seen, is costs are coming in higher than we expected. Getting a building permit, all of the municipalities are backlogged. So a building permit that you would have thought might come out in 4 to 8 weeks, you're now 8 to 12 weeks. So things are getting delayed that do make it a little bit more problematic overall. But we've selectively gone back and are working on ROI projects in our hotels, as well as just, on-cycle renovation. The brands have been good about being a bit flexible in terms of PIP requirements and new brand standards that they had been rolling out pre-pandemic and postponing some of those dates. That gives owners some flexibility on how they address those items. So it's across the board, it remains a asset by asset situation because some properties it's hard to say you're going to go ahead and make such a significant reinvestment in the property.
And you have to have conviction that you're going to see your way out the other side. Okay, quickly, which properties are performing better than you thought? Which aren't? I mean, you always hear drive-to destinations, leisure resorts are the best, extended stay, and urban hotels, sort of, particularly large group meetings hotels, are still sucking wind. What are you seeing in your portfolios as far as the recovery?
Yeah, well, for us, it's wished we had nothing but leisure resorts in our portfolio. I can tell you that. So that is our winner of our portfolio, without a doubt. Is we have a high-end property in Napa that's doing extremely well. That has been great performance. As soon as California opened up, even our properties. I mentioned earlier, I think that we have a Holiday Inn at Disney. And that asset's done really well because we traditionally have been primarily a leisure transient guest that's coming to experience sleeping versus corporate meetings. Across the street, we have a 1,000-room hotel, and there our transient business has been good, but our group meeting business has been very slim. So Florida's great, California's better. We look at Northern California, where we have a corporate hotel in Silicon Valley, not doing well. That's probably going to be one of our last hotels to recover because it's so heavily dependent on a corporate business traveler. And then in technology, that be more flexible about the return to work. Fortunately, we did have exposure to some of the larger markets like Boston, New York, Chicago, San Francisco, that seem to have a lot of headwinds, both with international traveler and that corporate business traveler.
Right. So Shai, what's performed to the upside, and do you think that the recovery in those types of properties is going to take hold sooner than the conventional wisdom had previously indicated?
Yeah, I think any report that predicted recovery and is predicting recovery is going to be wrong, and we've seen it already with the domestic resort destination exceeding 2019 in certain markets, right? If you look at Miami resorts, there are some of them are 17% up in RevPAR to 2019. So again, real estate is a market by market, street corner by street corner kind of play, and that's the beauty of our business. For us, what surprised us to the positive was the extended stay, right? So we have quite a few hotels in extended stay, and you're starting to question, am I in the hotel business or in the housing solution business, right? So the cap rate tells me I'm the hotel business, right? But when 80% of your business is 30 days or more length of stay, you're really in a different business. And I think that with the recent transaction of Extended Stay of America, you can see that there start to be a little bit of blurry lines between hotels and this extended stay and the housing solutions. And if the infrastructure bill passes through, you can only imagine what will happen to extended stay product and to limited service along highways. So overall, limited service always performed relatively better, was less choppy, but extended stay comes out as the MVP of the crisis.
Yeah.
As it pertains to the rest of the market is exactly as Eva described. Domestic leisure is doing fantastic. People are sitting on a lot of savings and are eager to be social again. And we're seeing that in Napa Valley, we're seeing it in other markets, we're seeing it in Florida. So I think that is going to have a longer tail. I think for me, where the puck is going is really group, right? I think that segment got hit pretty hard. But if you think about groups, associations, corporations not holding their meetings for 2 years by the time we get vaccination and all that, you have 2 years of pent-up demand with a relatively limited amount of supply in terms of meeting space and large hotels. The hindrance to that will be international visitation. So maybe the large conventions lag a little bit, but domestic corporate is definitely going to happen.
Yeah, and look, we've seen it already in some of the hotel conferences that we're familiar with in terms of if they hold the conferences, people want to go. They're thirsting to be out there and to be with other people. As long as they're comfortable doing that, we're already seeing it. So I agree 100%. All right, why don't we start talking about the future, sort of where we're going post-pandemic in the hotel transactions world. So Dan, for you, the conventional wisdom was values were down 30 to 40%, right? This was sort of early on in the pandemic. As a matter of fact, REIT prices were down 30 to 45%, ultimately recovered. And, you do the math on, how much debt can you get and what kind of returns you need and how much time do you need to bridge to a recovery. That's where values were. But there wasn't a lot that happened, at least from an outright sales standpoint. So maybe you can just talk a little bit about what did happen, but really quickly, let's talk about what's going to happen. Where do you see values? Where do you see the current state of the market?
Sure. Yeah, and I think there was definitely conventional wisdom to your point about the 30 to 40% discount. We looked at the math early on, And we were believers, having kind of rebuilt our view on the market, that generically the hotel industry was going to recover by 2023. And so we said, look, if you bought at a 30 or 40% discount, you recover by 2023 on an unlevered basis, it was a dramatically outsized yield for a hotel investment. And that to us was a bit of a gating issue in terms of people being willing sellers. One, just selling at that discount, but two, selling to someone where they might, achieve a 15, 16% unlevered IRR, which is sent to a lot of people seem very wide, right? So that was part of the challenge. So what we saw was rescue capital. We also saw a fair amount of transaction activity at thinner discounts. And I think where 30 or 40% marks clearly would have been in the big northern tier cities, right? In a New York, a San Francisco, Chicago, where there was very little transaction volume. So if you look at like year to date this year, and if you look at kind of since the pandemic, about 70% of the transactions were in the southern half of the United States and California.
Right.
And so those markets were late cycle growth markets. They were anticipated. There's a lot of leisure markets in there, and a lot of people anticipated them to be rapid growth. So the hot new cities, right? The Nashvilles, Austins, Charlestons, Savannahs, go through the list, along with all the other core southern cities in the U.S., and then California always being California. So I think where people saw those transactions were done at lesser discounts. So, you're looking at more like a 10 to 20% discount. And then today in the resort space, I would venture to say you're at par and have been for a little while. And then I think as you kind of roll through, you'll start to see transaction activity pick up in the northern tier and in the more urban locations. I think that's a couple of factors. One, there's just way more equity than there is opportunity, and that's slowly growing, right? The amount of assets in there year to date, I think we're up like 130, 140% transaction volume from anemic levels, particularly Q2 last year, kind of year to date through May. So you're seeing that uptick come. And then if you look at what's out there today, there's a lot more product in the market today than there was before. And it's a little more diverse. It's not just resorts. It's not just the southern half of the U.S. And again, I think part of that is the pricing has gotten so competitive in the resort space, as one example, that people who are being opportunistic, and I'd be kidding, Shai and Eva can give more color here, are starting to think about how do we play New York City? How do we play big group hotels in major cities where those transactions were clearly on pause, and they were complicated, right? They probably had organized labor with a very heavy carrying cost. A lot of them had ground lease structures, had brand encumbrances. And so they were harder to work out and work through during the pandemic with much lower demand than you saw in the southern half, where you had a lot of leisure assets that, were breaking even kind of coming into Q3, right? So it's a very dynamic market. I think volumes will be up significantly for the rest of the year.
Yeah, no question about it. And you're absolutely right. I mean, the mark to market on the REITs was, again, 30 to 45%. Right. But in the private markets, that's where buyers wanted to buy, but there were no sellers. So that's why you saw deals getting done at 15% discounts.
So low.
Right. And that's why volume is so low. And I think we all believe that's going to change now that there's more conviction in terms of of fundamentals. Sure. So even Shai, maybe give a combination of two things. One, provide your view on the current state of play in the transaction market, but also where are you finding transactions? Is there more interesting product, attractive opportunities in the marketplace? Is there still distress, or are things coming back? Shai, why don't you hit on that? I'm sorry, Eva, go ahead.
Doesn't either way. I was going to say, I think for us, we've kind of struggled to find our spot so far coming out of the pandemic. We've looked at a number of opportunities and not been able to reach the pricing that the assets ultimately traded at. And so we keep hunting and trying to understand how we do underwrite the recovery. And how fast does an asset come back? But I think almost more importantly, we have to challenge ourselves is what is the next ability to move performance both in terms of occupancy and rate? Because if you're underwriting just to go back to 19, you're not going to be successful in any actively bid process. So it's understanding how much more rate growth there is. And today you're hearing from a lot of markets that are having particularly this leisure demand increase, where they're moving rates very quickly. And if that's sustainable, it's a great reset for industries that traditionally have been very competitive on the rate side. Through the last cycle, we did great with occupancy, but you didn't see the rate growth that we probably should have achieved for a variety of reasons. And so with some inflation, that may be our opportunity to push rate. So trying to understand how do we underwrite that and feel comfortable with that risk profile.
Understood. Shai, if you could answer that also, and are you doing any providing preferred equity to owners, or have you done any, not taken preferred, but provided preferred and bridge capital? I don't know, what type of transactions are you seeing?
So for us, being opportunistic investors, I think and I think Dan mentioned, there's so much liquidity in the market that there were better shops suited for the pref, because as you know, it's a little bit lower than the threshold that is required in opportunistic funds. So we attempted early on, but it was quite competitive. So the short answer is no. We tried and we didn't. I think it's a function of the amount of money today, which ties to a little bit your question. If you look at the amount of capital raised by private equity through to date, I think we're sitting on a $360 billion of cash, unspent cash, right? Globally. It's double where we were at the end of the great financial crisis. So the magnitude of liquidity is incredible. And the question then becomes what happens to values, right? Which is where we're still lamenting not buying every possible traded stock in March and April. In the hotel space, Brookfield was quite active in other verticals. I think you have to really reflect on your conviction regarding the hospitality industry, right? Because the reality is we're going to be in a low yield environment for an extended period of time. You know, even if interest rates go up to 3%, right? If your business cannot sustain 3% interest rate, you have other issues, right? So you're going to be in a low interest environment, which is going to force even more influx of investments into real assets, right? Now, the beauty of our business is that we have real assets combined with operating entities. And that's a very attractive place to be, right? In that space that you can have real assets and the operating leverage that Eva alluded to, right? Where there's more discipline in ADR, we'll see if it holds. And we're forced, due to the labor environment, to do more with less. So you're going to have very attractive recovery on the EBITDA level. And with that, it's you have to really have tremendous conviction. We're closing on about 4 or 5 deals through the first half of the year. I expect the volume to pick up. For us, it's a function of understanding we're not financially engineering anything. We're really focused on the operation side of things. And we have conviction on the long-term viability of the business. If inflation comes in or doesn't come in, you just have to have a lot of conviction around that. But I think the opportunities are going to be ample.
Yeah. So talk about a few specific deals that you're working on. Let's we only have 20 minutes left, and I want to get into some specifics. So maybe you can give some specific examples of sort of how you're underwriting, how are you doing your pro formas, where are you valuing assets? Can you give sort of a case study of something you bought recently? Just anybody want to pick that up?
I think we're a little bit in the early stages of the transaction activity, as you mentioned. But think about it. I think Dan can correct me if I'm wrong, but I think there's about 700 hotels that are in special servicing, right? So there's about $18 billion of CMBS loan in terms of volume delinquent, much higher than the last crisis. So I'm watching that closely, and our team is watching that closely. And I think that is going to be a interesting state of play. More particularly, where we're focused now is either JVs or partnerships with brand and managers, because we believe that coming out of this crisis, there's going to be a lot of interest in unique brands that you offer a unique value proposition, and we've seen it through the crisis. So to the extent that there's groups in Europe, in different markets, we're seeing it in Asia, we're seeing it also in the US, that we really want to partner with them, fuel their growth, because we believe in the business plan. So we're spending a lot of time on those kind of portfolios.
Got it. So you're looking at investments not only in pure real estate, but also in the operating entities.
Right. It's an OpCo. PropCo.
Got it.
With a lot of growth for the PropCo.
Yeah. Understood. Eve, anything you can share with us in terms of
well, I wish I had a great deal I could tell you about, but we keep underwriting, but we haven't been successful thus far. So
what do you attribute that to? Is it cost of capital, conviction on the pro forma? I mean, what do you are others just being more aggressive?
I think, when I see what transactions have been announced, I'm not certain they have a dramatically different cost of capital than what we have for, our normal competitors in the space. Obviously not like a high net worth or something, but probably, I have to be critical of myself. I'd say, probably not optimistic enough on the ability to move performance, on the out years to a new level in terms of both rate growth, but then we always look at that exit cap, and do we believe that a certain property in a certain market can sell for such a high prune price, right? And as a result, not being maybe as aggressive as we could be on the exit cap and having a higher cap than potentially our competitors may be underwriting.
Yeah.
So that's actually, where I'm kind of looking back at what we've been looking at and saying, where were we too conservative? Could we have gotten to that number ourselves?
Right. Yeah. I mean, the variables are, what's your pro forma? What's your mix of debt and equity and your cost of debt and equity? How much money are you going to put in the property over and above the FF&E reserves? And what's your exit cap, right? And so, you have to sort of look at all of those. Dan?
Yeah, one of the interesting things, Art, that it comes really from Eva and Shai's comments, and your question is, who are the players that were successfully getting transactions done? And one of the interesting things is, number one, so that 2x the amount of liquidity from crisis to crisis was a huge impact on it. But a lot of the early buyers were in one of two categories. They were either private equity or they were high net worth. Okay, the private equity guys who did the most transactions, the groups that did the most transactions, generally didn't have legacy hospitality assets. So, you weren't seeing, probably on one side, you weren't seeing the degree of impact in your own portfolio and taking human resource and working on your own portfolio, so you could kind of dream a little bit more and kind of run a little faster at a transaction. Or the high net worth who really just wanted to put cash to work. And a lot of the high net worths we work with invested all cash because they didn't have really good alternatives. So they weren't so worried about the short, and a lot of these guys bought all cash, a lot of these groups, because they weren't worried about the short-term costs. They sort of had faith that the debt markets would compress. And so our capital markets group's been fairly busy over the last 6 months financing trades that we did in 2020. Because now that the cost of capital is compressed and the ability to it's still fresh equity, so it still looks like an acquisition, but it's at a much better basis. So I think that sort of conviction that comes with kind of a clean slate definitely drove a lot of volume early on. And as a result, people could triangulate between 19 cap rate and unlevered IRR and fundamental basis and come up with a place they wanted to play. There's a great quote.
I'm sorry. I'll let you do the quote. Are investors looking at 2019 cap rates? I mean, that's sort of saying, okay, what am I buying off 19?
Yes. Yeah, I would say 19 is one of the key metrics, right? So you're looking at 19. Until recently, you were looking at unlevered IRR because you knew full well, like in the first 24 months, even if you leveraged, you were going to refinance. Again, assuming all things are good. You always have to make assumptions, right? Everything's forward looking. and then, what's my fundamental basis? And the other thing that we've seen interesting is in those growth markets, to Eva's point about where are you comfortable basis going in, going out, since COVID hit, we've seen record per key prices in Charleston, Savannah, Orlando, Dallas, most recently, kind of a whole new order in terms of the view on fundamental value. And I think some of that is scarcity. Some of that is a belief that supply is going to be fairly muted for a while. And, so you sort of have that dynamic that's driven pricing in what people think this is the best market for next cycle. If I'm buying and then the other thing is a lot of the best assets have traded. In each one of those cases, you'd say the first or second best asset in each one of those markets is what transacted at that price.
Yep. All right. What was the quote?
Oh, no, it was just, I remember John Gray had quoted on this thing, and this was sort of what I thought about philosophy, and sort of goes to Shai's point. He said, in the fullness of time, people are rewarded for picking the right neighborhood, not the right house. And so everybody's picking their neighborhood. So you'll see private equity groups like, for instance, the TPG, who got a great focus on kind of high-end, high-quality, recent vintage select service. Others are focused in on resorts. Others are focused in on sort of these core lake, kind of the new markets, right? And so people are picking their neighborhoods and making their bets there. And I think that's what's driven a lot of the activity so far.
Yep. No, I think that's right. So the theme of this panel is when does the pace pick up? Anybody have any predictions of when we're going to get back to not even the 40 billion we were at, but 10, $15 billion of actual transactions, not restructurings or rescue capital? When are the floodgates going to open? And a lot of it, by the way, is driven by the sellers willing to sell.
Yeah, I think some of it is driven, as I mentioned, by the CMBS special servicing receivership funnel that needs to work through. So you have a lot of inventory sitting there in the pipeline. It's also people building that conviction that this is a good place, just like Dan mentioned. New buyers are coming into the market and starting to moving some of that merchandise. You mentioned Mark Elliott, who was a great friend of the firm, but he used to quote the statistics that were always quite astonishing. In the last 10 years, in 20 years ago, for a period of 10 years, we had 12 transactions at $1 million per key. So that was from 2000 to 2010, right? From 2010 to today, we had 54 transactions at $1 million per key. We're starting to see the same multiplier at $2 million a key. Mm-hmm. And last week, we saw a trade at $2.5 million a key, right? So there is a sort of an industry rejiggering, right, in terms of expectations. And again, it's going to be a function of GDP growth and a function of interest rates, and none of us can predict that. And that's why it comes down to conviction. Where does it open? I mean, it's opening soon because there's only so long that you can sit on those funds that you raised by some other groups. The question is, do you spend it in logistics, housing, hotels? That and within hotels, what kind of hotels and what markets? We see tremendous opportunities in India.
Companies that buy houses all over the company and rents them, right? Right. So I think, but I think that you're already starting to see it with the extended stay transaction, single assets. There's a pickup. The number of BOVs in the market today is really picking up. Good. Hey, Steve, we have 10 minutes left, and I do want to get to M&A. Are there any questions from the audience that you think are? I think
one question that was interesting, I don't know if anybody wants to pick up on it, had to do with where they see, what a reasonable cap rate is from your perspective. Like, what. Obviously, we have changing debt costs right now. We have Shai's point. I don't know who's going to make money on a $2.5 million a key hotel, but where are the cap rates going? Eva, you were going to say something?
No, I was going to think that's a great question for Dan. He probably sees the most. And so,
yeah, and I'll actually, let me jump on what Shai said just for a second. I'll talk about cap rate, Steve. So we talk a lot about drive-to leisure as being kind of like the bellwether and kind of where actually the best performing sector was what we refer to as private jet-to leisure, right? The private jets moved around. You can go get on your plane. You can go. It's a very small crowd, but that crowd has grown dramatically, and the supply of those assets that trade for $2 million a key has really not grown at all. And so that's where we see that. And I would say the cap rates in that space are in the mid-single digits. Those are hotels that make legitimate money and perform well. But I would say, other than in the leisure space, cap rates are on current, and I would say those are somewhere in the 5-6.5%. And I would say everything else we're looking at 2019. So you're seeing select service in the sort of 7.5 to 8.5, and then you're seeing full service in the kind of 7.5. Obviously, you will see 10s and you'll see 5s and everything in between. As I like to say, cap rates are actually a pretty lousy metric for hotels because cash flow changes every day, and the business plan that Shai and Eva will execute might be very different than the prior owner. But yeah, I'd say we're seeing cap rates or measurements really on 19 today because cash flows aren't there. It's not meaningful to say, oh, it's a 2. You know, it wasn't bought at a 2. It was bought at a 7 on 19.
And they're looking at IRRs and equity multiples and then comparing that to, okay, then what does that mean in value relative to 2019? Mm-hmm. I think that's clearly the answer. I'm
sorry, Eva, there were 2 questions relating to you specifically having to do with conversions. One in San Jose and the other in Sao Paulo. Are those things that you're working on right now?
Nothing in Sao Paulo, that's for sure.
That's what I thought.
San Jose, when we acquired the hotel, and of course we closed January of 2020, so bad timing. But we converted from a Hilton franchise to Hilton managed. And change that agreement, and while securing some flexibility on our exit, that a new owner could flip it back into a franchise if that was desirable. So not really a conversion, of any strong magnitude.
Okay. All right, quickly, we have 4 minutes. Real estate transactions also aren't just single assets. There's a lot of M&A that goes on. The last big M&A we saw was the mergers of a couple of REITs, RLJ and Felcor, Pebblebrook and LHO. Back in 2007, when we saw unbelievable volume, it was take privates. Shai, you're probably best positioned for this, and Dan as well. Talk about it. I mean, are you going to take anybody private? You have an investment, Shai, in Hospitality Investors Trust. Dan, you're about to sell a small REIT, Condor. I think it's 12 hotels or so. We're going to see more step up in any of those activities, mergers, take privates, et cetera, on the public side.
Yeah, when you're sitting in the thick of the crisis, you have all these opportunities and you can't find somebody that will sell. Now, prices moved up, everybody wants to sell and seize the opportunity. I think, look, we always look at the M&A landscape. We're always interested on large transactions. I think that the debt market is getting there. So you're getting a lot of support from the debt market, which is great for our business. So that is step 1. Step 2 is for the management teams to realize what's ahead of them. Companies that are concentrated in certain markets that are going to be slower to recover, that are capex restrained, older assets, or non-distinct type of assets. Those are going to be opportunities that we'll look carefully at, and we'll focus on. We'll also focus on portfolios that are diverse. So we sit in a place where we can do both office, retail, hotels. So those kind of companies could be of interest to us. So without sharing too much, we're working on quite a vast pipeline globally. Mm-hmm. But again, there's still a big gap between the pricing that you have in public markets and some of the operating reality of the assets. I would say that.
And typically to get a public to private deal done, you have to have you have to do a deal 15-20% above where the shares are currently trading to get buy-in. Early on in the cycle, they certainly weren't willing to do that. They were trading too low, and now the REIT share prices are all the way back. So it's difficult to get a deal done. But Dan, maybe you can comment because it's out in the market on Condor. Just your thoughts on that market in general.
Yeah, I would just, we're going to represent them in the sale of the portfolio of the assets, right? So the company's going to sell the assets, which is where the transaction path they've chosen. Can't really comment on that particular one, but I would say, look, I think, we're starting to see portfolio transactions and larger, bulk transactions coming around. Obviously, ESA, very different animal, but we saw extended stay trade. And we think that there's a lot of interest in the select service and the extended stay space, kind of a shy reference. So I think, for instance, you'll see, kind of what Highgate, has been working through with Colony and some other things. So I think you will see transaction volume pick up on the portfolio side, public and private. And then I think, certainly there's always been that desire, where, certain REITs haven't gotten to a certain scale, right? Where there's a likely M&A, and it could be as much merger as it could be acquisition. I mean, when you think about the amount of capital that's on the sidelines and how the debt markets have improved, it's creating an environment where these things can happen, subject to some, conviction about the pricing premium you referenced.
Got it. Yeah. Steve, anything else from your view of the
I guess I haven't seen something here. I'm just wondering whether or not, especially from Shai, are you looking also at international, M&A like that? Because I would imagine, aside from the tanking of the U.S. dollar, that's a different issue. Whether or not the available smaller brands, et cetera, might be better off outside our borders.
Yeah, that's a great question. So again, we have offices in 30 different countries, and we think we have distress. Not so much, but other countries are really feeling it, right? So there's a lot of opportunities where there's people reaching out to us, which will present incredible opportunities for collaboration, right? Because we understand we're operators, we're owners. The firm has been around for 100 years. So people find a lot of confidence in our long-term view and somebody that really understands the issues facing them, they're facing. So we're seeing activity in Asia. We're seeing activity in Europe quite a bit, across Europe, Southern Europe, Northern Europe. But still the competition there is just as fierce, right? These are smart, astute investors. Some of them are very attached to it, family businesses that are attached to it. But we do see we have a great interest to expand internationally. And Lila is a great example where we probably will double the size of the company this year because the crisis has presented so many opportunities where we took hotels and were able, despite the current environment, grow market share. So we plan to do quite a bit of that.
Right. Good. I think we're at the end. So if I could just be so bold as to sort of summarize what I think everybody said, so we just sort of encapsulate it. Owners are going to sell for the same reasons they've always sold. End of fund life issues, return capital to investors. They make a decision they don't want to invest in the property any further. So it's better selling now than investing in the future. They may have debt coming due, so it makes sense to sell, et cetera. It's really all the same reasons. And those reasons are now going to be more achievable, or should I say the values that those sellers want to receive are more achievable now that there really is a light at the end of the tunnel. You've all read the articles about the airport's full, airplanes full. That's going to manifest itself in hotels starting to be full. The other sectors, that segments, particularly corporate and corporate group, will start to catch up. And what I'm hearing from the panelists is there's debt available in the marketplace. There's certainly plenty of equity available in the marketplace. When you have willing sellers, we'll start to see more and more transactions in the marketplace. So to answer the question, when will the volume start to pick up? I think it'll start in the second half of this year, and I think 2022 will be very, very robust. Feel free to disagree with me, anybody, but I think that's sort of where we are. The folks on this panel, notwithstanding all the stresses of the last year, you all look good. You don't look too stressed out, and that's good. That's good to hear. So, Steve, I don't know if you have a closing, but I think we've
I just want to thank. I just want to thank, of course, Eva and Shai and Dan for your participation, and of course Art for his continual support and engagement with the Center for Real Estate and Finance. And I know we're just getting over time, so I want to thank everybody in the audience. Please remember to take a look and watch, because we'll be having some more webinars come the fall. So thanks, everybody.
Thanks, everyone.
Thank you.
Thanks, guys. Appreciate it.